national income. Okay, we're going to be studying this. And national income accounting, what is it? It is a set of rules and methods that are used to measure the output of an economy. Okay, basic. Then, what is the concept of national income? There are different concepts like GDP, NDP, GNP, and NNP. So many concepts with that. We'll see one by one. Now, first one we'll see what is GDP, gross domestic product. Now, it has three words: gross, domestic, and product. You should know the meaning of all these three words. Gross. What is the meaning of gross? Gross means total market value. This is the meaning of gross of all the final goods and services produced within the domestic territory of a country during a specific period, generally financial year, that is from 1st April to 31st March. So here domestic is also given. What is domestic? That means domestic territory, right? Domestic territory of the country. Now, what does this mean? Domestic territory. It includes political territory. It includes territorial waters. It includes embassies, consulates in other countries, right? Then ships, aircrafts, fishing boats owned by residents of the country. All this includes the domestic territory. Okay. Among these people, whatever they produce, it's part of the GDP. So let's say this is the domestic territory of India. Okay. Now let's say a foreigner comes here, from outside he comes, and he starts producing here in India. So whatever he produce here, that is part of the GDP. Anything produced within the domestic territory, okay, irrespective of whether they are residents or foreigners, it should be produced in the domestic territory. That's all. That is part of the GDP. Now here I told territorial waters. Now what is this territorial waters? This one I just made here. This is that blue color highlighted. No, this is territorial waters. It's like this. Like this is the continental shelf, and this is the baseline. From the baseline, if you drag 12 nautical miles, that would be the territorial sea. Okay, that is what is there here, no? Territorial sea, territorial waters. So till 12 nautical miles, whatever production is happening, that is part of the GDP. After 12 nautical miles, there is contiguous zone, another 12 nautical miles from here to here. Then comes exclusive economic zone, that is from the baseline 200 nautical miles. Okay, this is how the seas are divided. Then final goods. What are final goods? It refers to the goods that are meant for final use. Example, like TV, car, and all for the consumer side. Final goods. Intermediate goods refers to those goods which are used as input to manufacture the final goods. Right? Like for example, for making this, what is this? फॉर एग्जाम्पल ब्रेड बनाने के लिए क्या चाहिए? वीट चाहिए ना. तो दिस इज एन इंटरमीडिएट गुड एंड दिस इज द फाइनल गुड. ठीक है, वी आर डन विद दैट. नाउ net domestic product. When we say net, no, we are going to deduct something. What are we going to deduct? We're going to deduct depreciation from the gross value. ठीक है, net market value of final goods and services produced within the domestic territory of a country during specific period. See, if we are doing here, net domestic product is equal to the GDP, that is the above one, minus depreciation, because we are calculating net over here. This gives a more better value of the GDP because depreciation is excluded. What is depreciation? Loss in the value of capital goods due to normal wear and tear and unforeseen obsolescence. Okay, it is getting older and older, that's why it is losing value, so we are subtracting it from the GDP. Hence NDP is a better measure. Next is GNP. GNP is gross national product. It is the total value of all finished goods and services owned by residents. Here no emphasis on residents of the country over a specific period. What do you mean by residents? It refers to a person or an institution who normally resides at least 1 year or more in a country and whose center of economic activity lies in that country. Okay. This GNP, no, it is conceptually better than GDP, better than NDP also. Why? Because in a globalized economy, let's say if you want to make a car has so many parts, no, engine, frame, tire, and all that. Let's say I go to US for making the engine, okay? Then you go to Japan for making the frame, and in India the tire gets manufactured. Okay, now all these parts are being manufactured at different parts of the world, right? If it was GDP, this wouldn't have been accounted because it is included only in the domestic territory. This car is manufactured in domestic territory, but these parts and all, right, they are manufactured outside the territory, so that's why. And I'm manufacturing the engine, you are manufacturing the frame, right? We both are residents, right? Resident means what? Who is ordinarily a resident of that country for more than 1 year. We are a resident of India for more than 1 year. We just went to US. I mean, I just went to US only for like 6 months, let's say, and you went to Japan for 6 months. So you are a resident of India, making that product. So GNP captures all this, but GDP doesn't capture all this. So GNP is a better measure than GDP. Okay, I hope you understood this. Then net national product, this is even better measure than GNP, because when the word net comes, you're going to subtract depreciation. So we are subtracting that. Now this is referred as national income, net national product. Okay, all the above four variables can be calculated at factor cost and market price. But at present, India's GDP and NNP are calculated at market price, and NNP is calculated at market price, is also called as national income. I will tell you what is factor cost and market price. It is very simple. We'll come back to this point again, okay? But first, let me just tell you the best measure. We saw, no, which is the best measure? NNP, right? Because it is subtracting everything, depreciation, then foreigners ka income, which is being generated in India, right? That is being removed. It is including only residents ka income. Okay, so that's why NNP is the best measure. Then comes GNP, then NDP, then GDP. Okay, this is how the best measurement is like what you say, scaled. Like NNP is best, but if you say value wise, because we are deducting so many things, NNP is the least value. Then comes GNP, then NDP, then GDP. People prefer GDP because it is easier to calculate and it is giving a more value, no? You get more value, so more you can boast more about it, that India's GDP is so and so. But if you see India's NNP, it is very less, because you are deducting all this depreciation, then foreigners ka income and all that. Okay, now factor cost and market price. What is this? We'll see factor cost. What is this factor cost? It is the cost of production that is incurred by a firm or an individual when producing goods and services. Okay, let's say a farmer is there. He makes wheat. Okay, he produces wheat. Now for producing this wheat, what does he need? He needs those factor of production, no? Factor cost means it's related with factor of production. We saw now what is factor of production? Land, labor, capital, entrepreneur, right? He needs all this for producing wheat. Now he has to hire workers. What is this? Labor. Let's say 100 rupees he spends for this. Then capital like tractor, fertilizer, seeds, everything he needs, no? So let's say he spends 100 rupees. How let's say for fertilizer, no, sometimes government gives subsidies as well. Let's say fertilizer is 100 rupees, but government gives 20 rupees subsidy, so net will be 80 rupees. And seeds also, let's say seeds are 30 rupees and government gives subsidies of 10 rupees, so it is 20 rupees net. So when you add 80 plus 20, you get 100 rupees. That is the capital. Then land. let's say he purchased the land for 100 rupees. Then entrepreneur, that is himself, he will, by selling this wheat, let's say he gets a profit of 100 rupees, which is assuming this, okay, this one. Now when you add all this, right, or land, labor, capital, and entrepreneur, you get 400 rupees. No, 100 plus 100 plus 100 plus 100. Now this is the minimum amount which he can sell to anyone, right? Below this he cannot sell, otherwise he will incur a loss. Okay, that is factor cost. Simple as that. It is the cost of production that is incurred by a firm or individual in producing goods and services. It does not include the taxes paid to the government, but includes subsidies. Now see, are there any taxes included here? No. But are there subsidies included here? Yes. See, there's 20 rupees and 10 rupees was there, no? There's a subsidy given by the government. That is included in this factor cost. Okay, next, market price. In market price, no? And this is the price that consumers will pay for the product when they purchase it from sellers. What is the thing? Consumers are paying for the product when they purchase it from sellers. For example, the same thing. That wheat is there, no? Wheat at factor cost is 400 rupees. Now let's say he wants to sell this wheat. He will go to Mandi. In Mandi, there will be a government officer or any person who's going to tax some amount, or some commission he will take, no? So let's say that is 10%. So that 10% is nothing but goes to the government for him to get the facilities of the Mandi. That's why they're charging this 10% tax. So let's say 10% of 400 is how much? 40 rupees. Okay, then this wheat, this price, no, already has subsidies. We have that subsidy amount was how much? 20 rupees. Okay, when we're calculating market price now, what we need to do is we need to see the market price, add the tax, and subtract subsidy. So what is the factor cost? 400. Okay, then what is the tax? 10% is 40 rupees here, and subsidy is 20. So when we do that, we're getting 420 rupees. So at factor cost is 400, and at market price it's 420. So see, it is more than the factor cost. So that's why when calculating GDP at market price, you tend to get a higher value, right? And that is not a good measure. That's why GDP at factor cost is much better than GDP at market price. Okay. Oh, I'll tell you one more reason also. I'll come to that. But till here, I think you understood. Okay. This government tax is nothing but indirect tax. Okay. Here I just gave you an example that he is going to Mandi here. After that, if consumer wants to buy this from Mandi, it will get transported to retail shop, and from retail shop, GST will be put on that. Then it will finally go to consumer, no? Or instead, consumer can just go directly buy from the Mandi. Right? So from when you give facilities like transportation, then transportation to retail shop, then put GST and all that. So all this gets added up, no? So we can just write indirect tax here, right? Factor cost plus indirect tax minus subsidy. Okay. Yeah, all this is done. Same thing that for above formula. Factor cost plus taxes, that is nothing but indirect taxes minus subsidies. Now this tax, what we have here, it doesn't contribute to production. Government is just levying tax for that. It is not contributing to any production of wheat or something like that. Even subsidies don't contribute to production, right? It's just money given to them for free for some welfare, that's all. It doesn't contribute to production. And here also it includes subsidies, no, in this factor cost. But indirect tax will always be greater than subsidies, because government just wants to extract as much money as possible from the people, right? So indirect tax will always be greater than subsidy. So this value will always be greater than this value. So this value will always be a positive value. Okay, so market price will always be greater than factor cost in case of India. Okay, now let's discuss, is the factor cost better than market price? Answer is yes. I already told you this, because it doesn't include taxes. Taxes doesn't directly contribute to production. Simply it is being levied on them. Now, GDP, no? I told you GDP means gross domestic product. In gross domestic product, foreigners are included. Like if foreigner comes to India, let me draw here. If the foreigner comes to India, he earns here, okay, then he can send that money outside India, right? He earns in here based on the resources of India, right? So resources of India are being used here, and then whatever income he earned, he's going to send it outside. Let's say he's from US, so he will send that amount to USA, right? So this is like a loss to India, no? That amount of money is going outside India, whatever he has earned, and that is included in the GDP. Okay, foreigner is related with GDP, and GNP is related with residents. Resident means, let's say in US, one Indian resident, he earns there, right? And he sends the money, whatever he earns there, to India. So that's a good thing for us. We are getting money, we are getting dollars and all that, right? That is associated with GNP. Now let's say we want to convert from like we know the GDP, we want to calculate the GNP now. How do we do that? Now to get the GNP, we need residents first of all. So what we do is, whatever income earned by Indian residents from outside, they will send money to India, no? So that we will add here, okay, plus, and whatever income the foreigners are earning in India and sending it outside, that we will subtract. So it is called as net factor income from abroad, this total value. So factor income of resident minus factor income of foreigner. If you add this value to the GDP, you will get GNP. Now you see here, GNP includes resident, we are including resident, and we are excluding the foreigner. So hence we are getting the GNP here. But for India, no, this net factor income from abroad is a negative value. Why? Because most of the firms in India, most of the non-resident firms in India, like Toyota, Suzuki, or before it was let's say like Harley Davidson and all that. So all these are non-resident firms, right? So what they do is they earn from here and they send all the money back to their home country, right? So it is going, profit and all is going outside India. So this value is becoming negative. Foreigner income is more. This value is more. Let me write another color. This value is more, but foreign income from resident, like we get no remittance and all that, that is very less. So that's why it is negative in value, or negative in case of India. This is not given in this book. That's why I'm telling you separately. This GNP is equal to GDP plus net factor income from abroad. This has been asked in many test series as well, so I just included it here. Okay, we covered everything here. Okay, per capita income refers to average income of people in the country in a specific period. That is national income by population. Very simple. Right, whatever national income is what? NNP by the population of the country. national income need not be only NNP, it can be any of those four, any of these four. Okay. For whatever the country is choosing, like India is choosing GDP, no? So GDP is the national income divided by population. Next, private income. Private income, the total factor incomes and transfer incomes received from all sources by private sector. Private sector means private enterprises and households within and outside the country. Now, what is this factor incomes? I told you, factor incomes is nothing but incomes earned by factor of production. And what is transfer incomes? Transfer incomes is nothing but remittances. Remittance means जो पैसा बाहर से आ रहा है, like from residents outside India. When they are working outside India, they send money to India, so that is remittance. Then disposable income. Disposable income is income available with people after paying income tax. Okay, self-explanatory, no need to explain all this. Now, apart from this, market price and factor cost, we have one more kind of price called basic price. What is the basic price? This is also very simple. We saw that wheat ka price at factor cost was 400 rupees, and at market price, so much it was 420 rupees. Right? We saw here, no? Where is that? Here. Here we saw factor cost 400, market price 420. So what does it mean by basic price here? Let's say this farmer, he utilized the land to produce this wheat. So he has to pay land revenue. Let's say that is 10 rupees. This land revenue is nothing but production tax. What is production tax? Production tax is nothing but a tax which is levied because there is some production happening. Okay, just because some production is happening, one tax is levied. That is production tax. Example is land revenue, stamp duty and all that. They are fixed. Okay, it doesn't depend on the amount produced. Like you produce 10 kg wheat, 1000 kg wheat, doesn't matter. They will charge only this fixed amount of land revenue. That is production tax. If you add this production tax, you will get basic price. That's all. You add that 400 to 10, you get 410. And this basic price, it doesn't include net product tax. What is product tax? This is one more kind of tax which comes later on. That is over here. Example is an indirect tax. Net product tax, this depends on the number of units produced, like basically volume of production. If you prepare, like if you make 1000 kg wheat this time, more tax will be levied here. Okay, it depends on the volume. So after all this, indirect tax is also put, that is GST. Let's say 10 rupees, and finally market price will be 420. So basic price is between the market price and factor cost. Okay, somewhere in between. That's all is all about basic price. I told you about this product tax, paid according to number of units produced. Okay, this part, number of units produced. Example GST. Then production tax. Some production, it is levied only when some production is happening. Right? It is independent of the volume of production, like stamp duty and land revenue. Now I already told you this, that NNP is the best value of national income measurement. Okay, now between factor cost and market price, which is the best one? Factor cost, right? We saw here factor cost is better than market price because it doesn't include taxes. See here. In factor cost, there is no taxes involved. All the taxes are coming later on. This production tax, this net product tax, all is coming later on. So this is the best measure because taxes don't contribute to production. Okay, so now we know that NNP is the best measure of national income, and factor cost is even more better than market price. So the most accurate measure is the NNP at factor cost. It's the best value of national income. Then why are we not using this? Why are we using GDP at market price? Because GDP is easier to calculate than this, because this has a lot of deductions, no, like where depreciation you have to, because net is included here. Net means depreciation, and depreciation is hard to calculate for capital goods. You don't know how to calculate this. It can't be accurately calculated. Then net factoring come from abroad. That one is, I know, what is this? Those two people, where are they? This one. Income abroad are earned by foreigner and income earned by Indians from abroad. It is hard to monitor all this. It's very complex for monitoring cross-border transactions. So that is also one of the reason why NNP is not used. I mean, not used. And then tax, whatever tax is there, no, NNP includes factor cost doesn't include a tax, right? For that you need to know what taxes are being levied first of all. The data is not readily available. So these are all the hurdles. It is really difficult to calculate NNP. So that's why we prefer GDP. We'll see further why it is given for later why GDP is taken and not NNP. Now we'll see nominal GDP versus real GDP. Nominal GDP is the GDP calculated at current year price. Real GDP is at constant price. That is nothing but the base price. Current price is the price prevailing in the market and it is not adjusted for inflation. Okay, current price is not adjusted for inflation, whereas constant price is adjusted for inflation on the base year. It depends on the base year, and the price is used to measure the real change in output without taking inflation. I'll take an example. Let's say 2011 to 2024. We are going to sell cars. Okay, one car is 10 lakh. Okay, 10 lakh per car. And by 2024, due to inflation, one car became 12 lakhs. Okay. Now number of cars sold. Let's say in 2011, 1000 cars are sold. In 2024, 900 cars are sold. Now what is the value here? Like the total value, sale of value. 1000 into 10, how much is that? 100 crores. Okay, and in 2024, 900 into 12, 108 crores. So from 100 crores to 108 crores, there is an increase in national income. Okay, but the quantity of cars produced has decreased from 1000 to 900. So this is not signifying a good, like the increase in national income doesn't signify that increase in goods are there. It is actually decreasing from 1000 to 900. So this is not a good measure, nominal GDP. Let's see real GDP now. 2011 to 2024. Cars is car ka price 10 lakh. In this case, no, in the real GDP, we take the same price. We assume that 2011 is the base year price, and we take the same price and calculate the national income. Number of cars was 1000. Here in this case, 2024, 900 cars were produced. So here 100 crore national income, and here it became 90 crore now. See, it has decreased national income. Since there is a decrease in the quantity of the cars produced, there is a decrease in national income. So this is giving a good measure, real GDP, than nominal GDP. It is adjusted for inflation here. See, 10, we took no 10 here, 10 lakh, that is, we are not taking into account of any inflation. But here inflation is there from 10 lakh to 12 lakh. So in nominal GDP, inflation is there. In this real GDP, no inflation. And based on this nominal and real GDP, they calculate the GDP deflator. What is this GDP deflator? We discussed in the previous class. It is an index of price changes of goods and services included in the GDP. It is used to calculate real GDP from nominal GDP. Basically, nominal GDP by real GDP. What did we get here? Nominal GDP as 108 crore and real GDP as 90 crore. No? 90 crores. So 108 crores by by 90 crores into 100, you get 120. Now this means that inflation grew at 20%. How 20%? We should do 120 minus 100. Now why 100 here? Why should we subtract from 100? Because let's say no inflation happened. Okay, let's say here in the nominal GDP, from 10 lakh per car, it didn't increase to 12 lakh per car. Let's say the price of the car remained at 10 lakh only. Then what would be the nominal GDP, nominal national income here? It would be 10 lakh into 900, which is 90 crores. 90 crores here, 90 crores here. So it would be 90 divided by 90 into 100. How much is this? 100. Right? So we have to do 120 minus 100, which is 20. So it signifies that inflation grew at 20%. Okay. This is the significance of GDP deflator. Now, calculation of GDP, there are three methods to calculate. One is production method or value added method, then income method or factor earning method, and expenditure method. We'll see this one by one. Production or value added method. GDP is estimated by calculating value addition done by the firms at each stage of production in all the three sectors. Okay, all the like primary, secondary, and tertiary. In each sector, the value is added. Okay, and after this, it is combined together to form GDP. For example, let's say this farmer grows wheat. Okay, wheat worth of 100 rupees. Now let's say 50 rupees of that wheat production, he consumes it, the farmer consumes it, and the rest of the 50 rupees he sells it to a baker, and that baker, he puts some value and he sells the, let's say he makes a bread or something, and he sells it for 200 rupees. Okay, now we need to calculate GDP over here. By which method? Value added method, the first method. In value added method, what we are doing, we are going to calculate the value of the baker, okay, whatever value is adding, and the value by the farmer, whatever value the farmer added. Now value by the baker is what? How much value is adding here? He bought it for 50 rupees and he's selling it for 200 rupees. Well, what is the value added? 150 rupees. 200 minus 50, 150 rupees. And what is the value added by the farmer? He produced the entire wheat. The entire wheat is the full value, no, for him. So it is 100 rupees. Right, so what is the total value? 150 plus 100, 250. We are adding the individual values of both the farmer and the baker to get GDP. Now let's say, what is the definition of GDP? It is the final value of all the goods produced within the domestic territory. Right, now final value of all the goods. What are all the goods? Wheat and bread. Wheat is how much? Wheat is 50 rupees, no? Final value 50 rupees, and bread, we are not considering this whatever he consumed here in the final value. Final value is what he has given to the other guy, to the baker here in this case. Bread is how much? He sold it for 200 rupees. So when we add this 200 plus 50, we're getting 250, no? 250 here and 250 here. So both the methods are correct. In both, like when we add value, we are getting 250, and when we are calculating final value, we are getting 250. So value added method is correct. So like that we calculate for primary, secondary, and tertiary, and we add all them to get GDP. Next is income method. Income method is another factor earning method. In this we just calculate the profit earned by all the firms, then interest received by the capital deployed, and rent receipt for the natural resource, like if you're using land, whatever rent you get from that. Then wages earned by all laborers, right? If you add all this, you get GDP. That is income method. Then expenditure method, consumption expenditure plus investment plus government expenditure plus net exports. Again, net is coming, so export minus import. This can be also written as private consumption expenditure. No, it can be either private consumption or government consumption. So it is private consumption plus government consumption, and investment. It can be private investment plus government investment. Okay. And net exports, export minus import. In this government expenditure, no, it is included in this government consumption over here. Okay, this is done. Investment both government private and consumption expenditure private, private and government. ठीक है, this is goes here also. So in the Indian economy, most of the GDP is contributed by private consumption, means household consumption is contributing to more GDP. Then comes all this private investment and government investment, that is 29%. And then government consumption is 11%, that is the least. Then import minus export is minus 2%. That means we are this value is negative here. That means we are importing more and exporting less, which is a bad thing. Right? That's why it's minus 2%. Then GVA, gross value added, same thing what we are doing, no, value added method. I explained this example, same thing only, but we are just adding for all the three sectors. That's all. GVA is the difference between value added of a firm's output and value of intermediate goods. We did here, no, where is that guy? Value added by Baker is how much? 200 minus 50, 150. Difference between value of the firm's output, but that is Baker output, how much? 200, and value of the intermediate goods, that is 50. So totally minus, if you do, 150. It is a sector based concept and calculated for all the three sectors individually, that is GVA for agricultural sector, manufacturing sector and service sector. We add all that when we get GDP. RBI introduced this new measure of GVA at basic price. We saw now what is basic price, where production taxes are included here. Production taxes are included, but it doesn't include net product tax. Net product tax comes in the next stage, in the GST stage. This is product tax, okay, to get market price. So RBI introduced this measure of GVA at basic price to measure the growth. Next, GVA at basic price is GVA at factor cost plus production tax minus production subsidy. This whole value, production tax minus production subsidy, is the net product tax. Now I told you this one. It doesn't include net product tax. 1 second. Where did that go? Here. Production tax minus production subsidy. Production tax can be land revenue and production subsidy can be fertilizer subsidy. Right? When you subtract them, you get net production tax. Okay, so basic price is factor cost plus production tax, that is this, minus production subsidy, or you can just write factor cost plus production tax. Okay, I think this is a much better representation of what is basic price. Okay, what is factor cost, what is basic price, and what is market price. Remember this this diagram, it will help. Okay, I think we're done with that basic price. Then land revenue. I told you land revenue is the kind of production tax, that is this one, and railway subsidies. Okay, this production subsidies is a railway subsidies is an example of production subsidies, or you can even write fertilizer also. In case of that wheat, fertilizer subsidy. And then production taxes and production subsidies are independent of volume of actual productions. I already told you this in this case. Production tax independent of volume of production, like stamp duty, land revenue. Irrespective of the volume of production, you just have to pay it. It's a fixed amount. Then change in methodology of GDP calculation before 2015 and after 2015. Base year 2004-5. This one was after 2015. Base year was 2011-12. Calculation. This was done at GDP at factor cost. I think now you understand what is this factor cost meaning and what is this market price meaning. Right. Afterwards, it was calculated market price. Now, if they calculated market price, what is going to happen? The money will be high. Like the GDP will be very high compared to factor cost. Before it was very low. Then methodology of capturing income. Before it was labor input method. What is labor input method? Let's say 10 workers are there. Each worker works for 8 hours. Then the total labor input is 80 hours per day. That was the previous method. Now is effective labor input method. Let's say both A and B should, like, for 1 hour work, the effective hours for A, let's say A is high skill and B is low skill. Okay, let's say for 1 hour work, A will have effective of 2 hours. Okay, he has an efficiency of 2 hours, let's say, and B has an efficiency of 0.8. So let's say they work for 5 hours and this guy works for 10 hours. So total how much? 2 into 5, 10 hours, and 0.8 into 10, 8 hours. So total is 18 effective hours. So in this case, we are inculcating productivity. That's effective. Productivity is included here. In this case, we are not including productivity, we are just including quantity. How much quantity of work is done. Here, quality is also included. Then source of data. Before, only RBI data was used, which consisted of only 4,500 companies. And here, after 2015, the ministry ka data was being used, Ministry of Corporate Affairs, based on 5 lakh companies. Then before, data of only value addition in farm produce was being calculated. Now, along with this farm produce, we are calculating livestock produce as well. Value addition in livestock produce. Okay, now I told you GDP has some limitations. It is not the best measure, but it is the most widely used measure because it is easier to calculate. Okay, it is not the best measure. There are some alternatives which is given next, but first we'll discuss why it has challenges. Uneven distribution. Right, with rising GDP, welfare may not increase because rise in GDP may be concentrated in few hands. Right, like if the GDP increases, it can be because only the rich people or the top firms are performing, whereas like the startups and all, they are like falling down, they're collapsing. Only the top firms may rise, and the welfare of only them can happen, not these low income people. So it's not a good measure. Uneven distribution. Non-monetary exchanges. GDP does not take into consideration the value of household work and care economy, as it is difficult to calculate the monetary value. Care economy means that taking care of the old age and all that. Household work, that is also not taken into consideration. Then externalities refers to the benefits or harms a firm or an individual causes to another for which they are not paid or penalized. For example, leather industry, it releases all the toxic waste to the water bodies that causes water pollution to the nearby areas. So there is no penalty imposed on these leather companies. So that is also not calculated. Or even if it is imposed on them, they have not paid it. Right. So that is also one problem. Then GDP can rise even if expenditure on security increases. Okay, due to rise in crime, which cannot be considered as an increase in welfare. Yeah, when you spend more on security to safeguard, let's say, northeast or maybe Jammu and Kashmir area, it doesn't contribute to any welfare. So again, GDP is another challenge of GDP. Now, what are the alternatives? There is green GDP. What is green GDP? Green gross domestic product is an index of economic growth with environmental consequences of the growth factored into countries' conventional GDP. Green GDP monetizes loss of biodiversity, and accounts for the costs caused by climate change. Okay, all the climate change and all is included in this. Then Human Development Index, developed by United Nations Development UNDP development program. It has three indicators: health, education, and standard of living. Under health, it measures the life expectancy at birth. Education measures the mean years of schooling for adults aged 25 years and expected years of schooling for children. And standard of living may how is the standard of living measured? It is measured by GNP divided by population. That is nothing but gross national income per capita based on purchasing power parity. Now, what is this purchasing power parity? It is nothing but the amount of money in rupees needed in India to buy the same consumption basket available for $1 in US. Let's say in USA, one basket of good is there, which consists of, let's say, for example, apple is there, orange is there, and a banana is there. Now, let's say this this basket of goods is worth $1 in US. This entire basket. In India, the same basket of goods for apple, orange, and banana will be worth, let's say, 20 rupees. So we can say that $1 is equal to 20 rupees. This is the purchasing power parity. Okay, for the same fixed basket, we are trying to see how much it costs in India. That is per PPP in terms of US dollar. So we measure the standard of living in terms of that. Then rank of India. It turned out to be 134 out of 193 countries. Rank 1 Switzerland. However, Indian government doesn't accept this kind of indexes because it is not measured properly. Okay, then gross national happiness index. It is developed by UN Sustainable Development Solution Network. It has 33 indicators under 9 headings. What are the 9 headings? Psychological well-being, health, education, time use, cultural diversity and resilience, good governance, community vitality, ecological diversity and resilience, and living standards. India ranked 126 out of 143 and Finland topped it. Okay, alright, we finished this chapter, national income.